If you have $5,000 to invest right now, you're facing one of the most challenging investment environments in modern history. Traditional safe investments are paying returns below inflation rates, while risky investments face unprecedented volatility and uncertainty. Most financial advisors will give you generic advice that ignores the specific challenges and opportunities of investing smaller amounts in today's economy. But I'm going to tell you exactly how to deploy $5,000 for maximum wealth building potential while managing the risks that could destroy your capital. This isn't about getting rich quick or making speculative bets. This is about building a foundation for long-term wealth using strategies that optimize smaller investment amounts for current market conditions. The key insight that most people miss is that investing $5,000 requires completely different strategies than investing $50,000 or $500,000. Small amounts can't be diversified the same way larger portfolios can, but they also have advantages that larger amounts don't have, including access to investments that become impractical at larger scales. $5,000 also represents a critical threshold where you can begin building serious wealth if you deploy it correctly, or you can waste years of potential compound growth if you make mistakes. The decisions you make with this money will determine whether it becomes the foundation of financial independence or just another small account that stagnates for decades. If you're serious about turning $5,000 into the beginning of real wealth, rather than just following conventional wisdom that keeps small investors poor, then subscribe to this channel right now, because the strategy I'm going to reveal is specifically designed for people who understand that building wealth requires thinking differently than the masses who never achieve financial independence. The first thing you need to understand is that conventional diversification advice doesn't work with $5,000. Financial advisors tell everyone to spread their money across stocks, bonds, real estate, and international investments, regardless of the investment amount. But when you only have $5,000, this approach creates over-diversification that guarantees mediocre returns. With $5,000, you can't buy meaningful positions in enough different investments to achieve real diversification. Instead of owning tiny slivers of many different assets, you're better off concentrating in fewer, higher quality investments that can actually move the needle on your wealth building progress. The mathematical reality is that $5,000 spread across 10 different investments gives you $500 in each position. These tiny positions generate minimal income and appreciation that won't significantly impact your financial situation. But $5,000 concentrated in 2 or 3 excellent investments can generate meaningful returns that accelerate your wealth building. The second thing you need to understand is that $5,000 is too small for complex investment strategies like individual stock picking, real estate investing, or alternative investments that require substantial minimums or ongoing management. These strategies work well for larger portfolios, but create unnecessary costs and complications for smaller amounts. Instead of trying to implement sophisticated strategies that require more capital or expertise than you have, focus on simple approaches that work exceptionally well at smaller scales. The best investments for $5,000 are often the simplest ones that provide broad exposure to wealth-building assets without high costs or management requirements. But simplicity doesn't mean settling for poor returns or avoiding all risk. It means choosing investments that provide excellent risk-adjusted returns while minimizing the costs and complexities that destroy wealth for small investors. The goal is optimizing your $5,000 for growth while avoiding the mistakes that keep small amounts small forever. The third critical factor is timing your investment deployment to take advantage of current market conditions rather than following generic advice that ignores economic cycles. The investment environment in late 2026 offers specific opportunities and risks that require tactical adjustments to basic investment strategies. Current market conditions include persistent inflation that makes cash and fixed income investments wealth destroyers, volatile equity markets that create buying opportunities for disciplined investors, and structural economic changes that favor certain types of investments over others. Your $5,000 deployment strategy must account for these conditions. The inflation environment makes it essential to invest in assets that can maintain purchasing power over time. This eliminates most fixed income investments and makes growth-oriented investments more attractive despite their volatility. Your $5,000 must work harder than historical periods when inflation was low and stable. Market volatility actually creates advantages for small investors who can deploy capital quickly and don't need liquidity for years. While institutional investors face constraints that prevent them from taking advantage of temporary price dislocations, individual investors with $5,000 can act decisively when opportunities arise. The fourth factor is ensuring that your $5,000 investment fits into a larger wealth-building strategy rather than being treated as an isolated decision. This money should represent the beginning of systematic wealth accumulation, not a one-time investment that you forget about for decades. This means setting up systems for adding to your investments regularly, reinvesting dividends and gains automatically, and building toward larger investment amounts that will unlock additional opportunities. Your $5,000 should be the foundation of a wealth-building machine, not just a static investment. The systematic approach also means choosing investments that can accommodate additional contributions over time without creating tax complications or forcing you to change strategies as your wealth grows. The best $5,000 investments are those that scale effectively as you add more capital. Based on these principles, my specific recommendation for investing $5,000 right now is a focused approach using two complementary exchange-traded funds that provide optimal exposure to wealth-building assets while minimizing costs and complexities. The first component is $3,000 invested in a broad market index fund that provides exposure to the entire stock market with minimal fees and maximum diversification within the equity asset class. This foundation provides participation in long-term economic growth while avoiding the risks of trying to pick individual winners and losers. I specifically recommend the Vanguard Total Stock Market ETF, ticker symbol VTI, which provides exposure to virtually every publicly traded U.S. company with an expense ratio of just 0.03% annually. This fund includes large companies, small companies, growth stocks, value stocks, everything you need for broad equity exposure in one simple investment. VTI eliminates the guesswork of trying to choose between different types of stock funds while providing the lowest possible costs for broad market exposure. $3,000 in VTI gives you ownership stakes in Apple, Microsoft, Amazon, Google, and thousands of other companies while ensuring you participate in whatever sectors or styles perform best over your investment timeline. The second component is $2,000 invested in a real estate investment trust ETF that provides inflation protection and steady income while diversifying beyond pure stock market exposure. Real estate investments often perform well during inflationary periods and provide income that can be reinvested for compound growth. I specifically recommend the Vanguard Real Estate ETF, ticker symbol VNQ, which provides exposure to real estate investment trusts across all major property sectors with low costs and broad diversification. This fund includes residential REITs, commercial REITs, industrial REITs, and specialized property types like data centers and cell towers. VNQ provides exposure to real estate without the complications and costs of direct property ownership while offering liquidity that real estate can't match. The fund currently yields approximately 4%, providing steady income that exceeds most savings accounts while offering potential for both dividend growth and capital appreciation as property values adjust to inflationary pressures. The 60-40 allocation between stocks and real estate provides optimal balance for current market conditions. The stock component provides growth potential and broad economic exposure, while the real estate component provides inflation protection and steady income. This allocation captures the benefits of both asset classes while avoiding over-concentration in either direction. But the power of this two ETF approach goes beyond just asset allocation. These specific funds provide access to thousands of individual investments that would be impossible to own directly with $5,000. VTI includes over 3,000 individual stocks, while VNQ includes over 160 REITs, giving you diversification that rivals much larger portfolios. The cost efficiency of this approach is crucial for small investors because fees compound against you over time, just like returns compound in your favor. The combined expense ratio of this two-fund portfolio is approximately 0.08% annually, meaning you'll pay only $4 per year in fees on your $5,000 investment. Compare this to actively managed mutual funds that often charge 1 to 2% annually, which would cost $50 to $100 per year on the same investment amount. Over 20 or 30 years, this fee difference compounds into tens of thousands of dollars in additional wealth for the low-cost approach. The simplicity of managing just two funds eliminates the complexity and decision fatigue that causes many investors to make costly mistakes. You don't need to research individual companies, time sector rotations, or make complex asset allocation decisions. You simply maintain your target allocation and add money systematically over time. Now let me address the specific implementation strategy that maximizes your chances of success while avoiding common mistakes that destroy wealth for small investors. The first step is opening a brokerage account with a low-cost provider that offers commission-free ETF trading. Vanguard, Fidelity, and Schwab all provide excellent platforms for this strategy. Avoid brokers that charge transaction fees or account maintenance fees that would eat into your returns. Also avoid brokers that try to sell you additional products or services that you don't need. The goal is simple: low-cost execution of your two-fund strategy without unnecessary complications. The second step is investing your $5,000 all at once rather than trying to time the market or dollar cost average the initial amount. With $5,000, the potential benefits of dollar cost averaging are minimal, while the opportunity cost of keeping money uninvested during strong market periods can be significant. Market timing is impossible to do consistently, and the academic research shows that lump sum investing typically outperforms dollar cost averaging over long investment periods. The sooner you get your money working in appreciating assets, the longer it has to compound and grow. However, once your initial $5,000 is invested, you should set up systematic monthly contributions that dollar cost average future investments. This ongoing investment discipline is more important than perfect timing of your initial investment amount. The third step is setting up automatic dividend reinvestment for both funds so that all income generated by your investments automatically purchases additional shares rather than sitting in cash. This reinvestment compounds your returns over time and eliminates the temptation to spend dividend income rather than reinvesting it. Dividend reinvestment is particularly important for small investors because it allows you to buy fractional shares and ensures that every dollar of income continues working for you. Many investors make the mistake of taking dividend payments as cash, which significantly reduces their long-term wealth accumulation. The fourth step is establishing a systematic investment plan that adds to your portfolio monthly or quarterly, regardless of market conditions. Even if you can only add $100 or $200 per month, this systematic approach builds wealth much faster than sporadic, larger contributions. The key is consistency rather than amount. Someone who invests $200 monthly for 30 years will accumulate significantly more wealth than someone who makes occasional larger contributions totaling the same amount. The systematic approach eliminates timing decisions and ensures continuous wealth building. Rebalancing your portfolio annually maintains your target allocation as the two funds perform differently over time. If stocks outperform real estate significantly, sell some VTI and buy more VNQ to restore your 60-40 allocation. If real estate outperforms stocks, do the opposite rebalancing. This rebalancing discipline forces you to sell high and buy low systematically, which improves returns while managing risk. Most investors do the opposite by chasing performance and buying more of whatever has done well recently rather than maintaining strategic allocations. The most important psychological element is maintaining long-term perspective during inevitable market volatility. Your $5,000 will fluctuate in value, sometimes dramatically, but these fluctuations are temporary while the long-term trend of equity and real estate appreciation continues over decades. Market declines actually benefit long-term investors because they provide opportunities to buy additional shares at lower prices through your systematic investment contributions. Don't view volatility as risk to your wealth. View it as opportunity to accumulate more shares of quality assets at attractive prices. Tax efficiency is important but secondary to investment returns for most investors with $5,000. Hold these investments in taxable accounts if you don't have access to tax-advantaged retirement accounts, but prioritize IRA or 401k contributions if you have available contribution room. The tax efficiency of index funds means that most of your returns will come from capital gains rather than taxable distributions, allowing your investments to compound with minimal tax drag. When you eventually sell, long-term capital gains rates are typically much lower than ordinary income tax rates. Here's what you can expect from this strategy over different time horizons. Over 1 to 3 years, your returns will be unpredictable and could range from significant losses to substantial gains. Focus on continuing your systematic contributions rather than evaluating short-term performance. Over 5 to 10 years, you should expect returns averaging 8 to 10% annually based on historical performance of diversified stock and real estate portfolios. This would grow your initial $5,000 to approximately $10,000 to $12,000 before considering additional contributions. Over 20 to 30 years, the compound effect becomes dramatic. Your initial $5,000 could grow to $50,000 to $100,000 or more, while systematic monthly contributions of just $200 could result in total portfolio values exceeding $500,000. But the real power of this approach is building wealth-building habits and knowledge that serve you throughout your investment lifetime. Starting with $5,000 and a simple two-fund strategy teaches you investment discipline while providing foundation for more sophisticated strategies as your wealth grows. The most common mistake is abandoning the strategy during temporary market declines or trying to optimize by switching to different funds or adding complexity. Stick with the plan through market cycles and resist the temptation to make changes based on short-term performance or market predictions. Success with this $5,000 strategy requires patience, discipline, and long-term perspective. The investors who benefit most are those who implement the plan systematically and maintain it consistently regardless of market conditions or external pressures to do something different. Now let me address the alternatives to this two-fund strategy and explain why they're inferior for most people investing $5,000. Many investors are tempted by individual stocks, cryptocurrency, or other alternatives that seem more exciting than broad market index funds, but these approaches typically destroy wealth for small investors. Individual stock picking requires expertise, time, and larger amounts of capital to achieve adequate diversification. With $5,000, you can afford maybe 5 to 10 individual stocks, which creates concentration risk that can devastate your portfolio if any single company faces problems. The two-fund approach gives you thousands of stocks for the same investment amount. Cryptocurrency and other speculative investments might seem attractive because of their potential for explosive gains, but they're essentially gambling rather than investing. The vast majority of people who invest in cryptocurrency lose money because they're buying into speculation without understanding the underlying technology or market dynamics. Target date funds and robo-advisors are marketed as simple solutions for small investors, but they often charge higher fees while providing inferior diversification compared to the two-fund approach. They also make decisions for you rather than teaching you investment principles that serve you throughout your lifetime. The biggest mistakes people make with $5,000 investments include trying to time the market perfectly, constantly switching between different strategies based on short-term performance, and adding unnecessary complexity that increases costs while reducing returns. Simplicity and consistency beat complexity and market timing for small investors. Another common mistake is treating this $5,000 as play money for speculation rather than the foundation of serious wealth building. This money should be invested with the same discipline and long-term perspective you'd use for larger amounts because it can grow into substantial wealth over time. Here's your specific action plan for implementing this strategy immediately. First, open a brokerage account with Vanguard, Fidelity, or Schwab that offers commission-free ETF trading. Complete the account opening process and fund it with your $5,000 within the next week. Second, invest $3,000 in VTI and $2,000 in VNQ as soon as your account is funded. Don't wait for perfect market conditions or try to time your entry. The sooner your money starts working, the more time it has to compound and grow. Third, set up automatic dividend reinvestment for both funds and establish systematic monthly contributions of whatever amount you can afford consistently. Even $50 monthly will accelerate your wealth building significantly over time. Fourth, review your portfolio annually to rebalance back to your target allocation, but resist the temptation to make frequent changes or switch strategies based on short-term performance. Consistency and patience are more important than optimization for building wealth with smaller amounts. The most important mindset shift is viewing this $5,000 as the beginning of financial independence rather than just an investment account. With discipline and consistency, this money can grow into the foundation of real wealth that provides financial security and independence. Many wealthy people started with similar amounts and built substantial portfolios through systematic investing rather than luck or special knowledge. The difference was maintaining discipline and letting compound returns work over long periods rather than trying to get rich quickly through speculation. If this strategy makes sense for your financial situation and you're ready to start building wealth systematically, take action immediately to open your brokerage account and deploy your $5,000. Every day you wait is a day of potential compound growth that you'll never recover. Subscribe to this channel for ongoing guidance about building wealth through systematic investing and avoiding the mistakes that keep small investors poor. Share this video with anyone who has small amounts to invest and needs practical advice rather than generic financial planning recommendations. Leave a comment below and tell me whether you're going to implement this two-fund strategy and what your target for monthly contributions will be. Building wealth requires community support and accountability to maintain discipline through market cycles. Remember, building wealth isn't about having large amounts of money to start with. It's about implementing proven strategies consistently over long periods while avoiding the mistakes that prevent compound returns from working their magic. Your $5,000 can become the foundation of financial independence if you give it time and treat it with the discipline it deserves.